We continue with our discussion on working capital and now start looking at a concept called the cash conversion cycle. So we're going to look at what is called as the cash conversion cycle. And before we reach the cash conversion cycle, we do need to understand how do we represent the working capital parameters in terms of days notation. So how many days are outstanding in terms of receivables? How many days are outstanding in terms of inventory? We have to learn that notation as well. This is not very different from what we have already seen, notations as a percentage of sales, right? So it's a manifestation of that. We will look at these data points as we go along. Let's first understand, for the purpose of cash conversion cycle, we will revisit a few concepts that we have seen, which are the turnover ratios. Now, textbook definitions of turnover ratio says receivables turnover ratio is credit sales by average receivables. Inventory turnover ratio is cost of goods sold by average inventory. And payables turnover ratio is purchases by average payables, in which case typically purchases are given by your cost of goods sold, whatever you have sold, plus any change in the inventory. Cost of goods sold plus any change in the inventory. So that's what purchases would basically look like. And based on that, we are kind of looking at purchases. In real life, however, most of the time such data may not be available. Companies may not tell us exactly what is the amount of credit sales and what is the cost of goods sold. So in real life, most of the times we just substitute everything with sales, right? If we substitute everything with sales, we will see what happens to the formula as we go along. But if we substitute everything with sales, that's also because some of this data is not really available to us in real life. Now, once we do this, once we get the turnover ratios, we convert that turnover ratio into the days notation by, you can be converted, this can be converted to number of days. You convert it to days notation by dividing 365 by the turnover ratio. So you take 365 and divide it by either the receivable turnover ratio or the inventory turnover ratio or the payable turnover ratio. And you get the data in terms of how many receivable days you have, how many inventory days you have, and how many payable days you have, right? Let's understand this. Let's understand this a little bit better. We will use an example to kind of understand this slightly better, and that will give us probably an idea. So assume that a company makes sales of 365 crore in a year, right? So on average, they sell rupees 1 crore per day, right? It also has receivables of 30 crore outstanding. So let's first use the formula calculation and comprehend. So what is receivable turnover ratio? We are going to use sales because we don't know what credit sales are by receivables. So we're going to get 365 divided by 30, right? Now receivable days, if you look at days, that's 365 by receivable turnover ratio, which is 365 divided by 365 by 30. And if you solve for this, you get the answer as 30. So 30 days is what is outstanding as receivables, right? The answer is 30 days. That's what we get, right? Now let's conceptually understand this entire premise in terms of how it probably looks like in terms of when the company sells it and when the company sells the stuff and when do they receive the money. For that, we are saying that every day the company is selling stuff worth 1 crore, right? Every day on average, the company is selling stuff worth 1 crore. So they sell something on day one, and let's say this is day one and this is day 365, right? At the end of the year, 30 crore is outstanding. So what must be happening is what they sell here, they collect after 30 days. What they sell on day 100, they collect on day 130, and what they sell till day 335, they collect here. Everything that they sell after this gets collected in the next financial year, right? So what must be happening is they are selling worth 365 crore. That's the sales number. They are collecting only 335 crore, which means 30 crore is going to go later, which basically conceptually gives us an idea that you are collecting the money after 30 days. And that's what we calculated. That's exactly what we calculated in our formula, which was 365 divided by receivable turnover ratio. And that was giving us the answer as 30 because we are collecting the money after 30 days. That is what receivable days mean in the context of our understanding. So if we use sales in the formula instead of credit sales, which is also going to happen most of the times, then for all practical purposes, we can arrive at this data, uh, which conceptually says that if you're selling it on a particular day, how many days will you take to recover the money or collect the money, right? In this case, that answer is 30. You can also calculate it in another fashion. What are you doing? You're dividing 365 by the receivable turnover ratio. That's nothing but 365 divided by sales by receivables. Can I do a little bit of rearrangement here? So I can do receivables by sales by 365, right? This formula can change here. Receivables can go up, 365 can come down. What does that mean? That means receivables by sales per day. Let's apply this formula. Receivables in our question is 30, sales per day is 1, we get 30. In other words, how many days worth of sales, days worth of sales is outstanding as receivables? Outstanding as receivables. That's what we were calculating when we were looking at the day notation. If we do the same with inventory, we will get how many days worth of sales is outstanding as receivables. In other words, it is saying how many days will it take to recover the money that is stuck as receivables, right? Now let's introduce the concept of cash conversion cycle. Let's look at this scenario. Let's assume that the company purchases inventory on day 0, right? So this is day 0, inventory is purchased. They don't pay immediately. They pay only after 15 days. So this is when there is an outflow of money, right? They take 20 days to convert inventory into finished goods, and then sell the finished goods as well, right? So they take 20 days to do that. And once they sell the goods here, they take another 30 days to collect the money, right? So let's note down, we are saying effectively that we have calculated inventory days to be 20. We have calculated receivable days to be 30. And we have basically calculated payment in terms of payable days to be 15. Now, that's what we have calculated, 20, 30, and 15. So the question we need to ask is how many days does it take for the company from the outflow till the inflow when the money is collected? What is that duration, right? That's the duration we are looking at. This duration is what is called as the cash conversion cycle. Why is this the cash conversion cycle? Is because payment is done here and money is received here. So you receive money here. What does this mean? You have basically added 20 days of inventory, 30 days of receivables, and subtracted 15 days here, correct? So effectively, what we have said is the cash conversion cycle is given by 20 plus 30 minus 15, that is equal to 35 days. What does this mean? This means that for 35 days, we have to fund the business. We will either borrow money because we are making payment and pay interest on that money for 35 days. Or if we already have the money in our cash account, we use that money, we lose interest on that money, right? So for 35 days, we're going to either pay interest or we're going to lose interest, and we have to fund this money for these 35 days. That's the definition of cash conversion cycle. So how do we calculate cash conversion cycle? We are adding accounts receivable days and we are adding inventory days, right? That's the amount of time from your buying the goods to your selling the goods and recovering the money. And from this, you subtract the payable days, right? So receivable days plus inventory days minus payable days is going to give you the cash conversion cycle. If CCC or cash conversion cycle is a positive number, you're effectively looking at positive working capital and you are funding your business during that period, right? It is also possible that you get this as a negative number, right? What happens if you get the negative number? Let's take a look at this case. You purchase inventory, 20 days you convert it to finished goods, 20 days you sell it and collect the money. So money is coming after 40 days. So after 40 days, the money gets collected. But because you are a strong player in the market or because your supplier is weak, you make the payment only after 55 days. So what is the inventory days here? That's 20. What is the receivable days here? That's 20. What is the payable days here? That's 55. What is cash conversion cycle? 20 plus 20 minus 55. That works to minus 15. What does this mean? You earn interest for these 15 days. You're not paying interest. This time you're earning interest because for this period of 15 days, you're going to make money on the money that is already received. This money that you have collected is in your bank account before you make the payment, and for 15 days, you're going to earn the interest. This will typically, a negative cash conversion cycle will typically correspond to a negative working capital environment, right? A company would be typically working in negative working capital scenario if there is a scenario of cash conversion cycle being negative, right? That's an important premise that comes up. Usually you will find that companies with positive cash conversion cycle would also, usually in 80 odd % cases, will also have positive working capital. Companies with negative cash conversion cycle will also have negative working capital because we're looking at those numbers itself. Ideally, you want that companies, just like they keep their working capital stable, they should try and keep cash conversion cycles stable as well, and if possible, reduce it. Reduce it by choice. We will once again use the term choice here, is because you want to do it. You want to reduce the period for which you are funding the money. In the first case, we were looking at 35 days as cash conversion cycle. I want to reduce it so that I collect money faster. But we need to do that by choice. We don't want to reach a scenario. So we don't want to reach a scenario where this is extending only because of The payable days are extending and it is turning negative because we don't have money to pay. That is not the idea, right? So standard premise, it's just a new way of kind of denoting it. All we are doing is we are looking at receivables. So far we were saying receivables as a percentage of sales and inventory as a percentage of sales. Note that we have just taken this number as a percentage of sales and divided it by 365, right? Or we have taken sales by 365 effectively. So net we have actually not divided but multiplied it by 365. So I'll repeat what we have broadly done. We have said that we were looking at receivable as a percentage of sales and inventory as a percentage of sales and payables as a percentage of sales. Now all we have done is instead of percentage of sales, we have divided it to get sales per day. And that's the day notation. We will get the same inference, same data in a different format, right? That's all we are doing. That's all we are saying, that this should remain stable, right? Let's understand this. Take a few examples. Company has receivable days at 45, inventory days at 75, and payable days at 110. Calculate the cash conversion cycle. That's 45 plus 75 minus 110. That's going to be 10. So 10 days is the cash conversion cycle for this particular company, right? Let's take another example. Given below are the company's turnover ratios. So we have the turnover ratios. Can we calculate the cash conversion cycle, right? We first need to find out in terms of days notation, right? So we take 365 divide by receivable turnover ratio, 365 divide by inventory turnover ratio, 365 and divide by payable turnover ratio to get the days notation of all these three. And then we calculate what is going to be the cash conversion cycle. For this, we'll use an Excel file. So that's the question that we have. Let's, in terms of days worth of sales, let's calculate this. I'll put receivables, I'll put inventory, and I'll put payables, right, in terms of days. And we are doing 365 divided by this number, and so on and so forth. Let's format it. So we are saying roughly about 35 days worth of sales is stuck in terms of receivables, 50 days, 51 days, and 42 days. How do I calculate the cash conversion cycle? That's receivable days plus inventory minus payable days. So 42 and half days effectively is what is the cash conversion cycle for this particular company. We took the turnover ratios, divided 365 by all the turnover ratios, got 42 and half here, and that's the data point we get. That is the answer to the question we were looking at. The cash conversion cycle is 42.5 days, right? That's the premise of cash conversion cycle. It is just a sort of a visual representation of what we have done so far, right? So it's another way of presenting working capital as percentage of sales. You're just doing it as a percentage of sales per day now, or as a measure in terms of sales per day now, which is what we were looking at while calculating cash conversion cycle. So that's broadly in this particular segment. We end with a question. Similar question to what we have seen earlier. Given below are the turnover ratios. Receivable turnover ratio is 21. Inventory turnover ratio is 15. Payable turnover ratio is 8. Calculate the cash conversion cycle for this particular company.